Okay, good afternoon, everyone. Thanks for joining us this afternoon. I'm Eric, the head of research at the AASB. Today, in this joint AASB and AUASB dialogue series session, we're going to discuss an important topic that has often been overlooked. In recent decades, we've witnessed some major global entities unexpectedly shutting down. They have surprised many investors, regulators, and the public in general, and possibly due to inadequate disclosures in annual reports or insufficient assessments by management when considering whether entities have any going concern problems. Recently, the AASB has included going concern disclosures in its research work program following public agenda consultation. This decision was prompted by concerns that the disclosures are inconsistent across entities, and there are also some preparers have expressed a lack of clarity or guidance on how to make these disclosures. Some have even suggested aligning the accounting standards for going concerns with the auditing standards. And therefore, the AASB has committed to monitoring this matter closely. So to shed light on this issue, today we have some fantastic keynote speakers and panelists. We're also pleased to have the reporting and assurance leader of CANZ, Amir Ganda, to chair this session. We also want to acknowledge the presence of the AASB Technical Director, Nicole Giles, AUASB Technical Director, Matthew Zapula, CPA Senior Manager, Ram Subramanian, and IASB member, Ann Tucker. But before I hand over the session to Amir, I'd like to encourage everyone to share thoughts or ask questions by using the Q&A function throughout the session, and we'll do our best to respond to those questions. Now, let me introduce Amir very quickly. Now, many of you may already be familiar with Amir, given his long-standing connection with the accounting and auditing profession. He has worked in prominent positions in the Big Four firms in Australia and London, and has been involved in significant policy-making roles. For instance, he served as the Deputy Director of Public Policy and Regulation at the International Federation of Accountants, collaborated on various projects with G20 and the OECD. So with his rich background, we would all agree that Amir is well equipped to lead today's discussion. So thank you, Amir. We now hand the session over to you.
Thank you so much, Eric, and thank you to the Australian Accounting Standards Board and everyone for having us involved and for continuing your work to continue to bring this dialogue together. I'd like to acknowledge the traditional owners of the lands that I'm on, and I guess others around the country. For me, that's the Gadigal people of the Eora Nation. Look, what a privilege to introduce the amazing lineup that we have planned for today. Going concern is certainly a topic which has drifted in and out of the consciousness, I think it's fair to say, with a slight lag behind companies blowing up and global financial crises and economic issues. And here we are coming right back into the topic, perhaps a few years after the spate of collapses in the UK inspired a lot of thinking about this. And it's great because we're just in time possibly for some more economic headwinds that might make the topic a little more in vogue. Not that I want to jinx that after hearing Dr. Chalmers last night talking about all of the things that we're doing to try to avoid the worst of that. Without further ado, we're going to kick off today with some fantastic research into this issue, and it's a real privilege to introduce Associate Professor and Head of Department of Accounting in the Faculty of Business and Economics at the University of Melbourne, Brad Potter, who is very, of course, well known throughout the profession and academic world, and has focused on accounting standard setting, financial reporting, but also very passionately, I think been making a call to action as long as I've been involved towards the integrity in our the evidence base for how we bring together the broader environmental and social implications of company activities in reporting. And it's also a real privilege to introduce Rebecca Maddox, Assistant Manager at the AUASB, but perhaps in a tribute to the connectivity that we're creating here between standard setting and academia. Rebecca is really here, I think, in a capacity as an academic. She has recently submitted her PhD thesis for examination at Monash University and has an extremely relevant piece of research to share with us today, looking at how users react to key audit matters. So without further ado, over to you, Brad and Rebecca.
Thanks, Amir, for that very, very kind introduction. So, and hello, everyone. Thanks for setting the time aside. So if I can just share my screen, and is that coming through? Anne, I can see you. Can you? Yeah, that's coming through. Okay, so thank you. So I guess the topic of going concern and disclosures around going concern are, close to all of our hearts. We know that a key question for preparers of IFRS financial statements is whether it's reasonable to make the going concern assumption. Certainly, I mean, we tell our students that in Accounting 101. But interestingly, and Eric alluded to this in his introductory comments, observing practice tells us that we're not that good at making going concern disclosures. And that's particularly the case, or particularly more important, when the going concern basis is found not to be appropriate. What do we do? So, and certainly we're going to hear in the rest of this session, and also as alluded to, as I said, that going concern disclosure is a topic on the agenda of standard setters. So what I'm going to do is I'm going to present findings for some research that we recently completed. It's co-authors Neil Farger from ANU, Stephen Taylor from UTS, and Mike Bradbury from Massey. And our purpose, or our interest in doing so, was to describe practice in terms of disclosure or going concern disclosure, in order to potentially and hopefully inform debate about the nature and type of guidance that regulators and standard setters might look to with regards to shaping what the future disclosures might be in relation to going concern. As I said, our main approach is to document disclosure practice by a smallish sample of Australian firms with material uncertainties, particularly noting disclosures about the indicators of uncertainties and the plans to address those uncertainties. And while our story is not about COVID as such, we were aware of the possible implications COVID might have for business disruptions, shutdowns, restrictions, supply chain implications, and things like that. So we were certainly interested to see how this played out in, as we documented disclosure. If I can just having a bit of a glitch with my apologies. Sorry about that. So to place in context, one of the first things we did is we had a look at relevant standards and guidance on going concern disclosure in Australia, New Zealand, UK and the US. Why did we pick them? Well, the first three obviously are IFRS-based countries. So prima facie, our starting assumption is that disclosure or guidance should be relatively consistent. US, I guess a comparison case, if you like. And in summary, I don't want to go through the kind of, the minutiae of what we found, but we looked at things like the wording in financial reporting guidance and audit guidance and where other sources of guidance might be. And we looked at guidance in relation to the criteria for assessing going concern, the look forward period and things like that. So there's a few things we looked at. But in summary, there was considerable variation in accounting and auditing standards relating to the going concern. Some, generally Australia, New Zealand and the UK, not surprisingly, were more consistent in the disclosures that in the guidance that we observed. The US were a little bit different. US applies accounting standards issued by FASB, for example, and we see some additional variations, particularly in relation to the wording around the certainty of the assessments of going concern and also the look forward period. We also took a look at the implementation and consequences of the regulations and guidance relating to going concern in the different jurisdictions. We know, for example, that the US accounting rules and audit guidance didn't initially land in the same place, and that took a little bit of time for them to be, for that to be tidied up. We know that going concern disclosures are informative, containing clear information about the future of going concern problems in firms. And we know, for example, that disclosures of going concern risk in the US increased after the release of the accounting rule ASU 2014-2015. But an interesting sort of observation, maybe we can come back to this later, is that across each jurisdiction, we have a history of relying on audit guidance for shaping the nature and content of going concern disclosures, as opposed to accounting guidance. Now, maybe the auditors in the audience will nod knowingly. Maybe most of us will say, well, that's okay, as long as it's somewhere, and maybe that's true. What we make of that is something that we might chat about at a later stage. Just to give you an overview of the companies that we looked at. So we focused on our sample, or not our sample, our selection, and I use the term specifically. We focused on 127 companies reporting at the end of June 2020 that also received modified audit reports for that year in relation to going concern issues. So it's not a random sample per se drawn from the population, but it is a selection of companies who were selected because they had a non-standard audit report, so qualified, modified, emphasis and matter, but not qualified. And there was a sort of a those companies that had reported by mid-September, and that was a practical element to that because we needed to get the paper written. So that was a practical limiting factor. So what we miss in doing that is where there is a level of uncertainty, but it's not formally noted by the auditor. So that's not what we're doing, and nor have we taken a random sample of companies reporting for that year. So we're focusing on companies that had material uncertainty relating to a going concern as highlighted in the audit report, and then we took a look at what those companies are disclosing. So in terms of the sorts of things we looked at, in the body of our paper, we then just tried to document going concern disclosures. So, we framed the discussion based on the content of the joint AASB, AUASB, or joint paper in 2020. Not mandatory, but it is a useful frame to think about how to organise and understand the disclosures that we observe. So in that joint paper, the boards put forward the idea that good going concern disclosure should indicate things like the nature and type of financial impacts of indicators. For example, how much and to what extent did the going concern problem, was the going concern problem driven by reduced revenue, increased expenses, negative working capital shutdowns, etc. And what are the plans for dealing with those problems? For example, negotiations with lenders or creditors, raising additional equity, cost saving, government support, etc. So what were the plans? And thirdly, what further strategies are management likely to rely on to address these problems? So, how much cash have they truly got in reserve? What's the expected period of hibernation? What does the future look like, etc., etc. So again, although COVID-19 represented a potentially significant exogenous, I put in inverted commas, shock and a cause of significant uncertainty, we kind of expected that a lot of the uncertainties or indicators of uncertainty that were disclosed might mention COVID. However, you can see that of the companies that we looked at, less than half, or only 45 of them mentioned anything about COVID. Right? Lots and lots. I mean, some of these classifications or indicators are fairly broad. Things like cash position, cash flow from operations. So whether cash flow was a key factor that almost every company mentioned. Many companies mentioned multiple factors. There was more variation in the nature and type and particularly the level of detail in relation to the plans. What did stick out though is that of the firms in the sample, 91 out of 127 had a material uncertainty in the previous year. And the other thing to note is that very rarely did we find the material uncertainties the content of a specific note. Now, maybe not surprising, but it typically resided in notes 1 and 2, 1 and or 2. So, you know, again, some might say it's a perfect spot for it. Maybe it is, maybe it's not, but, you know, certainly something to consider because, again, what our main focus was in documenting practice. So if you remember from the second slide, the well-represented firms or industries in our sample were materials, pharmaceuticals and software and services. So all we then did is broke up the data and sort of had a look at disclosure practices within each of those 3 industries to see if there was variation across industries. And I guess one thing that struck us is, so this is the same set of data tabulated, but just for, you know, teasing out what happened across those industries. And so what I guess struck us was, despite the very different economic activities across those industries, we do observe a high degree of similarity in the frequency of the disclosures about current position and situation, and that they're mainly in relation to losses of cash or cash position, and the extent to which information about future plans is or is not provided. And there was also a degree of similarity, and a strong degree of similarity, in the reasons why material uncertainty remains. So draw from that what we may. You might think that, well, okay, the materials, pharmaceuticals and software and services, the other way of looking at that is that each of those industries involve a degree of exploration, degree of uncertainty and things like that. So maybe it's not surprising that there were similarities. So I guess in summary, I'm conscious of time. In summary, some concluding insights, or what can we learn from it? Guidance on going concern disclosures is most often in auditing standards, the detail of which differs across jurisdiction. The guidance is silent on the accounting approaches to adopt where the going concern assumption is not found to apply. And so we felt, oh, the lights have just gone off. Anyway, we felt that that was pretty relevant in generating potential further work to understand the costs and benefits of different regulations that might be considered. And, you know, what I guess the next bit of work we might consider is having a look at management disclosure about the viability of companies that are financially stressed, but where the auditor doesn't formally note that in the, in the audit opinion. So that's a sort of little kind of bit of extra work that we think might be beneficial. So anyway, happy to take questions later on, but in the interest of time, thanks for your time, and I'll throw back over to you.
Thanks a lot, Brad, and they were fantastic insights. I'll ask everyone to start putting your questions into the chat from now, please, if you can. I think Brad has a hard finish at 5, so it'd be great if anyone's got thoughts or questions around that material, if you can put those in from now. We'll make sure we jump onto those straight away at the as we get kicked off with the panel discussion. But to take us there, Rebecca.
Thank you, Amir. Interesting presentation, Brad, also. So hi, everyone. It's my pleasure to provide an overview of my research today. So just bear with me while I share my slides. Okay. So can you see my slides okay? Yeah, perfect. All right. So today I will be providing an overview of 2 of the studies that I conducted as part of my PhD at Monash University. So both of these research projects are centred around the impact of audit report going concern disclosures on investor judgments. So just to begin, there is a wealth of research already which explores the consequences of going concern opinions or modifications on stakeholders, particularly those that use archival data to measure market reactions. Given that the reporting possibilities had been broadened with the onset of key audit matters, I decided to conduct 2 experiments using investors. So how I did this was I recruited these participants through the online platform Prolific, which is renowned for its high recruitment standards, low cost, or reasonable cost, I should say, and high data quality. So there was the option to pre-screen participants to ensure that they have adequate investment experience and knowledge, and also have a history of providing good quality and usable responses. Of course, being an experiment, there are both pros and cons, being that the real world generalizability is somewhat limited, while on the other hand, there is that added ability, I guess, to establish causation. So the motivation for both of these studies stemmed from, I guess, discussions around fraud and going concern, which happened to reveal that some stakeholders were perplexed by the use of both key audit matters and material uncertainty related to going concern paragraphs to communicate going concern related information in the audit report. So this ultimately begged the question as to whether or not investors understand the difference between and therefore respond appropriately to an actual material uncertainty versus a close call. So as a result, both experiment 1 and 2 explore whether the type of going concern disclosure contained within the audit report, so whether it be a key audit matter or a material uncertainty paragraph, whether that impacts investor judgments around going concern, investment risk, and their likelihood of retaining their investment. So I'll now take you through, I should have sort of explained a little bit more. So there is a difference between both experiments. So while both experiments share that commonality of looking at whether the type of going concern disclosure impacts investor judgment, they also look at other factors. So with the understanding that investors may consult other sections of financial statements or other sources of information to obtain a view as to the future viability of a company, I also look at the internal or external source of the going concern uncertainty disclosed by management in the notes to the financial statement in experiment 1. Experiment 2, on the other hand, looks at whether investors become desensitized to particular disclosure if it recurs year on year. All right, so looking at experiment 1 more closely. So the participants in this particular study were asked to assume that they are an investor in a large listed company. They were provided with a series of case materials, such as extracts to the financial statement. So there was a 2-year modest loss. So given the nature of this particular study, the financial health of the company in question did need to support the existence of any uncertainty with respect to going concern. So that's why there was that modest loss. They're also provided with a audit report that contained either a key audit matter on going concern or a material uncertainty related to going concern, as well as a note disclosure which stated compliance with the going concern assumption, as well as a sentence outlining the source or, I guess, cause of the going concern uncertainty from the perspective of management. So if the uncertainty was attributable to internal factors, participants were told that management chose to suspend operations due to repairs and maintenance, whereas in the external condition, participants were told that management was forced to suspend operations due to market conditions. So I guess based on that, the former alludes to circumstances that are within the control of management, whereas the latter alludes to circumstances that are beyond the control of management. All right, so I'll now take you through some of the findings for experiment 1. So put simply, investors assess the likelihood of an entity remaining a going concern to be greater when going concern uncertainties are conveyed in a key audit matter as opposed to a material uncertainty paragraph. So this, I suppose, alleviates concerns around whether the difference in terms of their relative severity is appropriately understood by users. The reverse of this is that investors rightly associate a higher level of investment risk with a MERG as opposed to a CAM ongoing concern. So the next set of findings introduces the source of the going concern uncertainty. So given that CAMs are rightly treated as being less severe than a MERG and internal attributions are reported in the literature as being more controllable than external attributions, as I alluded to earlier. I also perform a contrast test, which compares a CAM ongoing concern and an internal source of uncertainty with the other three cells. So in line with what I was expecting, when the cause of the going concern uncertainty is attributed to an internal, so when it's controllable rather than external event, participants in the CAM condition are significantly more likely to assess an entity as a going concern. So this could be the result of a high level of congruence between the auditor and management. So given that a not so severe going concern issue in a CAM and a controllable cause for concern via the attribution results in a higher going concern assessment. I also looked at a range of auditor and audit report attributes between both a material uncertainty and a CAM, and I find that auditors are considered to be more credible, the audit report more reliable and more understandable when presented with a MERG as opposed to a CAM. And for completeness, I also looked at emphasis of matter paragraphs, and I find that they are treated the same way as a material uncertainty. All right, so I'll now take you through the second experiment that I conducted. So participants in this experiment were provided with similar case materials in that they were asked to assume that they're an investor in a large listed company, but in this case, they were asked to assume that they had been one for the past 5 years. Again, the audit report that they received contained either a CAM ongoing concern or a material uncertainty. The point of difference in this study compared to the last is that participants or investors were additionally told that this is either the first time or the 5th year in a row that the audit report has appeared this way, so has either contained a CAM or a MERG. So just to reiterate, this particular study sort of looks at whether investors become inured to a message that is reported the same way year on year. All right, so I'll now take you through some of the findings. So in line with the first experiment, participants again assessed the likelihood of an entity remaining a going concern to be greater when going concern uncertainties are communicated in a CAM as opposed to a MERG. They are also more likely to retain their investment if going concern is discussed in a CAM rather than a MERG, which I guess alludes to any potential capital market consequences as a result of either form of disclosure. When the duration of the going concern uncertainty is considered, investors are significantly more likely to assess a company as a going concern and are more likely to retain their investment when the audit report contains a CAM and when it has been reported for the 5th year in a row. So this finding suggests that a close call on going concern becomes increasingly more favourable over time. So there does appear to be a reduced responsiveness, I suppose, to the concern around going concern year on year. So in addition, I also looked at investors' fair warning assessments and intention to sue the auditor or management in the event that they sustain any losses. So in this final set of questions, participants are told that the company cannot pay their debt and that they have made a significant loss on their investment in that particular company. So overall, when I'm comparing just a MERG to a CAM, participants do consider a MERG to be fair warning, and rightly so. When the duration of the going concern uncertainty is 1 year, they rate a CAM and a MERG about the same if the entity subsequently fails. However, when the duration of the going concern uncertainty is 5 years, investors do not consider a CAM ongoing concern to be fair warning and are subsequently more likely to sue the auditor for any losses that are sustained as a result of that company failing. I also compare a CAM ongoing concern, with a control group. So the control group received a clean audit report with no mention of any uncertainty relating to going concern. And interestingly, when the duration of the going concern uncertainty is 5 years, the impact of reporting on going concern uncertainties in a CAM actually reverts back to the control. What I mean by that is it's actually treated the same way as if there is no mention of any going concern uncertainties in the audit report. All right, so to conclude, contrary to the concerns which I mentioned in the opening, investor judgments do differ depending on the type of going concern disclosure present in the audit report. So there doesn't appear to be any confusion around the relative severity of a CAM versus a MERG. While there was minimal finding for attribution, CAMs are viewed more positively when the source of the going concern uncertainty is attributed to internal factors by management, so when it is controllable. And I suppose this really kind of speaks to the effects of having consistent, I guess, disclosures between the auditor and management on investor judgment. And finally, recurring disclosures may in fact contain or carry, I guess, unintended consequences such that investors may become desensitized to messages that are repeatedly received or expected. So that concludes my presentation. Thank you all for listening.
Thanks so much, Rebecca. That's really interesting, especially I think the finding that about that desensitization, but also that they're looking at the audit report more is really key. And actually that's a great segue into what we have next on the menu. And I'm really pleased to bring in two panel discussants alongside Brad and Rebecca. Firstly, Anne Waters. Anne is Deputy Technical Director at the Auditing and Assurance, Australian Auditing and Assurance Standards Board, where she's responsible for the planning, research, development and delivery of Australian auditing standards as part of the AUASB's strategy and corporate plan. And I think in the time I've known Anne and been knocking around in the space, I think she's very much appears to me to be the go-to person for the tough policy challenges that they come up against over there, whether that's in the AUASB or often in the Financial Reporting Council as well. And secondly, it's really fantastic to have Toby Langley joining us. Toby is Executive General Manager of Customer and Strategic Finance at Xero, which is listed on the ASX and domiciled in New Zealand, of course. I think everyone will know very well what the Xero cloud-based accounting software and business platform is all basically taken over the world, I think, in the last few years. And it's amazing when I'm in New Zealand, wandering past the otherwise, I wouldn't say humble, but unassuming offices there of such a successful company. But it's great to have Toby because, of course, Toby's background before that was in a number of senior equity research roles and at the at the Bank of America, actually. And so having that perspective of an investor is so crucial with all of this. So thanks both Anne and Toby for joining us. I might kick off with a question for Anne, and of course there is a very long ED out from the International Auditing and Assurance Standards Board. In fact, one of my team today was talking about the idea of using ChatGPT to summarize that ED, which I think is 177 pages. I don't know how that worked, but I'll find out soon enough. But why has that IAASB exposure draft been done, and why are they looking at revising the relevant auditing standard, ISA 570?
Okay, thanks, Amir. Yeah, so the IAASB have just last week issued an exposure draft on ISA 570, and we have issued that exposure draft as well, looking for comments from Australian stakeholders. So please have a look at our website. Today, I'll quickly go through why, and sorry, not the slide yet, if that's okay. I'll quickly go through this. I'll quickly go through why the IAASB are revising 570, and will very quickly go through some of the key changes But please have a look at our website. Please have a look at the ED, and we've also done a webcast which gives you a little bit more detail. So why have the IAASB looking to revise 570? It's because of what Eric spoke about before. It's the fact that there have been a number of high-profile corporate failures that was really raising concerns around whether entities were appropriately disclosing going concern risks and actions to mitigate those, and was the auditor appropriately focusing on going concern. You could argue that going concerns assessments and disclosures around risk and strategies to mitigate those risks are probably, you know, the key disclosures that users are looking for. And the auditor plays a critical role in those disclosures, in ensuring those assessments and disclosures are appropriate. So when there are a number of corporate failures and you had things like COVID going on, you've got continual sort of uncertainty and economic pressures, the IAASB felt that it was in the public interest to have a look at the auditing standard to make sure that there was appropriate requirements and structure that the auditors could follow to help them in making their assessments. So the IAASB commenced the project in about 2019. They did engage with the AUASB around the accounting standard requirements, because clearly it is management's responsibility, and they're the ones that have the key role around understanding the entity and understanding going concern risks, and should be making those assessments and disclosures. And the auditor looks at that with obviously an independent lens, which is really, really important. The IAASB did engage with the IASB, and the IASB's view, I understand, is that the accounting standards are principles-based, but those principles are appropriate, and there is enough in there to drive appropriate risk assessments of going concern and disclosures. So that was the IASB's position. When the IAASB first raised going concern, they issued a discussion paper, and we did significant outreach on that discussion paper to understand what people's views were about what was the issue with going concern and how could that be addressed. We received very clear feedback from our Australian stakeholders that the accounting standards weren't sufficiently detailed, and that the auditing standards had more detail in there, and it was often the auditor really driving some of those disclosures where it was really more appropriate that management should be doing those. So that was the clear feedback that we received. The IAASB, as I said, have released the exposure draft, and so the key enhancements that they have put in the revised 570 is to really increase the robustness of the procedures the auditor must do when identifying risks relevant to going concern and to assessing management's going concern assessment. So there's a lot more requirements around appropriate risk assessment, and then certain procedures that the auditor must do when they're assessing management's going concern assessment. So I think one of the impacts will be that auditors will be asking for more detail from management in relation to their going concern assessments. And one of the other key proposed enhancements, this is an exposure draft. Sorry, can you please put up the slide now, please? Is that they are proposing increased disclosure in the auditor's report about going concern matters. So for all entities, there'll be a going concern paragraph in the auditor's report, which states that the auditor has concluded that management's use of the going concern basis of accounting is appropriate and that no material uncertainty exists. So it's felt that this would be appropriate to increase user confidence that the auditor has looked at going concern and that their conclusion in relation to going concern is clearly stated in the auditor's report. And another disclosure in the audit report, so there's sort of like three buckets. You've got no going concern issues. You'll tell the users that you agree with management's assessment. Then you've got events or conditions that cast significant doubt, but there's no material uncertainty. So you're at a close call, or maybe before a close call, there are some events or conditions which raise some concerns. So the going concern section will state that they conclude that they agree with management's use of the going concern basis of accounting again, and that there's no material uncertainty. However, for listed entities only, they will then refer to the disclosures that the entity has made around those events or conditions. Now, Brad mentioned earlier that there's sometimes inconsistencies around some of those disclosures. So I'd be interested in people's views as to whether this will create some practical issues if the auditor's referring to some disclosures which maybe the entity is unwilling to make. Then your next bucket is when you have a material uncertainty. So that paragraph for a lot of entities will not change. If there is a material uncertainty, the auditor will document that in a paragraph titled Material Uncertainty related to going concern, and they'll say that they agree that the going concern basis of accounting is appropriate, but a material uncertainty does exist, and then they will reference to where those disclosures are in the financial statements. Then for listed entities only, the auditor will then describe how the auditor has evaluated management's assessment, which has enabled them to conclude that the material uncertainty is appropriate. So you can see there that one of the real changes being proposed is that the auditor will now say more about going concern in every audit report. Now, for listed entities, they will say even more. And part of the reasoning for that is that for listed entities, if you have a going concern issue currently, they're likely to be in a CAM. If the auditor made a judgment, it was a key audit matter. So they are discussing the procedures and the disclosures, or they're already in a material uncertainty paragraph. So then the auditor would include how they have the procedures they have performed. So that's a summary of where the AUASB are going. However, this is still at exposure draft period, so people can provide us with feedback on that. Thanks, Amir.
Thank you, Anne. And certainly some major changes there, and in fact, sort of, you know, actually bringing out more for the auditor to include, which is interesting given one of the major challenges we've been talking about for so long is the slightly lopsided amount of disclosure and responsibility that auditors take on around this. Toby, if I can turn to you for a moment, as an investor, what challenges have you encountered when you're assessing, you know, entity going concern based on their financial reports?
Thanks, Amir, and thanks everybody for involving me in the panel today. So as you mentioned in my intro, so I actually spent most of my career as an extra research analyst, and I hope to be able to provide some perspectives on this point. I guess if you're probably like most listed company analysts, going concern issues don't tend to arise that often, and they tend to be obviously implicitly binary events. But where I think a lot of the related disclosure becomes useful is it helps to inform the user, and more specifically investors, in understanding the risks that they are assuming as a holder of either their equity, or, you know, in some instances they'll be holding on to a debt instrument. And that's where I think that there is this really interesting opportunity for disclosure, be it in financial reporting or from the audit report, to really flesh out that spectrum between risks that the company is managing or facing day to day because of external or internal factors, or because of financial factors at play, assessing those risks through time, and really understanding what the potential earnings or growth impact might be on the business. I think the going concern might seem like it's I guess an extreme indicator to that point, but I think that's where the real merit comes, because I think it does force a lot more of the conversation to come to the surface. And I think, as both elements of research I think I've talked to, there are to some extent some inconsistencies in the way that related information can surface at the moment. And I think if we can get greater organization around disclosure, better consistency, there is more familiarity with the metrics and indicators. People can take more confidence if they know that there's sufficient rigor, both in the way that management are able to stand behind assertions that support a going concern statement. This is all, I think beneficial to putting financial reporting on a stronger position more broadly, but also just putting greater confidence into the capital markets environment, full stop. I did say I didn't observe any going concern issues in my equity analyst career, but what I did benefit from was the introduction of key audit matters. And I can see, I think to varying degrees initially, but I think over time it has become far more of an area of focus for both investors and analysts. I think the direction of travel in terms of asking questions around how they should be thinking about not just current year performance, but how are the indicators, the new indicators that a company is reporting, how do they impact the franchise value? How do they impact the overall strategic footprint, if you like, of the business? Increasingly, that is coming far more to the surface in the way that companies and management teams are required to tell the story of their company. And I think with the introduction of sustainability standards, that is only going to, and while that looks, through one lens, that's about beefing up ESG and sustainability related disclosures. But another way of thinking about this is it just provides additional understanding and context for the user to understand how the business is operating, how it creates value, how it supports its stakeholders, and again, not linked specifically to the current period, really through the strategic cycle, and understanding that value creation process.
Yeah, that's really interesting. There's actually a question or a sort of a comment that an attendee was hoping more onus would be put on management rather than auditors, given it's their accounts. I guess it's their company. And you've mentioned a few examples there, Toby: sustainability reporting, and the business, more disclosure around the business model, for example. But do you have any more ideas as to what sort of information might be useful to help investors really get an insight on these risks, so it isn't just a binary thing which happens once in a blue moon?
Yeah,
you do get a heads up. What would help with that?
Well, so I think scenario analysis and sensitivity analysis is usually the way to go. Investors are normally quite quantitatively motivated in terms of helping them understand what's going on. If I for my sins, covered the insurance sector for a long time. So the way, one of the key sort of additional areas of disclosure was around, confidence in intervals that were disclosed alongside reserve indicators that that a general insurer might be booking on a given period of time, and it gives investors a sense of comfort as to whether or not those reserves are like, the probability of adequacy is the metric that they would be disclosing on a periodic basis. And I think really standing back and understanding what the metric might be. There's a big focus right now on long-term climate emissions, and for certain sectors and for certain companies, these will become potential going concern risks for many of those businesses. And so what are the critical assumptions within that long run carbon emission profile that are difference makers? And for some companies, they have got the luxury of time to make an assessment on them, if we're being, you know, specific about the emissions profile. But being able to identify, you know, where I work now at Zero, we have quite a different footprint to a lot of other companies, as you might imagine. And the big one for us is air travel. We're a global business, so that's a big one. Cloud hosting, and then even things like entertainment and the type of food that we offer is because in absolute terms, Zero does have quite a small footprint. So these things that might be innocuous for another business are proportionately quite a lot more meaningful for Zero. So, you know, we're having to create those scenarios, not just to engage with investors who are wanting to understand better what the sustainability risks might be, but we're also having to do it for our internal stakeholders as well. So, for example, you know, we're looking at the mix of protein types on the menu that we use for events. Beef has quite a different profile to chicken, has quite a different profile to a vegetarian diet. And I think the, you know, and at the end of the day, I think making a difference on long run factors like climate is going to be about progressive incrementalism. And so these kinds of things feel small today, but they are the kinds of things that we will need to make a difference on over time. And so I guess it's a bit of a long explanation, but I think the key really is about making it real for people. And I think sensitivity analysis or scenario analysis is the way to really do that.
That's fantastic. I mean, it's similar to some recommendations actually that we've brought together from consulting a few years ago with our membership and other stakeholders while that inquiry into auditing was happening. And I think in the UK they were looking at that type of disclosure. So it's fascinating. But just so I make sure I understood right, so with the protein types, are your investors trying to get a read into how well the business is doing based on whether they're getting beef or chicken? So
not directly, but you know, if we're asked, you know, what are our top emission categories, the menu's up there, right? It's so, you know, it's travel, it's cloud hosting, and it's entertainment, of which catering is a big proportion.
Yeah, no, that's fascinating. And I think anecdotally, maybe an example of why there does need to be some better direct reporting around going concern by management. And I suppose there are many investors and analysts turning to those kind of signals, and you'd have to think that hearing it from the management themselves would potentially be better. Now I want to go to Brad before you have to jump off, Brad, with just a question, I guess, for everyone on the panel. In your view, how important is it that the auditing and accounting standards and the approach around going concern are aligned, and why or why not?
Thanks, Amir. I guess my initial reaction is that intuitively they should be aligned. You know, whether or not that be, you know, particularly around key elements, key identifiable elements, you know, the look forward period, you know, the criteria for identifying and triggering disclosures around the going concern, they should be aligned. And, you know, it makes sense to do it because, you know, but I do, and, you know, we wrote about this a little bit as well. I mean, I do think there's a lot of intuition behind it being a joint. I don't feel, I mean, I know there was a comment in the chat and I understand it, but I think the good going concern disclosure kind of outcome is a consequence of the preparers and the auditors working together. And so I think that can only sensibly happen when the guidance the different sources of guidance do talk to each other. So that's my initial thoughts on that.
Thank you, and I appreciate you answered a few great questions there around the makeup of the ASX, which of course does have a lot of explorative mining companies. Is there anything you wanted to say just live on that?
Yeah, so that was a great question. So the question was, to summarise the question, essentially it was, given that there's a lot of companies in the ASX listing that have face inherent uncertainty or are involved in exploration, etc., we didn't look at those. No, we didn't. What we made a different design choice, and we focused on companies that we knew had some sort of material uncertainty related to going concern, and we looked to see what the specifics of the disclosures were there. That's clearly an area, as a consequence of that approach, clearly an area that we haven't looked at yet, but is worthy of further research, must be worthy of further research, as alluded to towards the end, are those companies that do face uncertainty, but where that uncertainty hasn't been formally documented by the auditors.
Mhm.
So what is the role and what are the potential nature and types of guidance that maybe could be put together for those firms to help people like Toby, and plenty of others. I'm just picking on him because I can see him, make some informed decisions about the actual nature and content of the financials and what the future might hold.
And as I said, that the proposed ISA 570 now will require the auditor to, if there are sort of events and conditions, to refer to some disclosure, and that disclosure will have to come through. I think it's paragraph 122 I wrote down, sort of 101, sort of, which is significant judgment, and is that sufficiently clear to preparers that they would have to, and because we do hear sometimes there can be disagreements between management and the auditor around what is an event and condition. We don't think we have a going concern risk here that needs to be disclosed.
Thank you. And it sounds like you're in the camp that they do need to be aligned. Is that right? And are there any other reflections around why?
Well, that's the feedback that we have received from auditors. In saying that was a number of years ago. I'm interested to see what feedback we get for this exposure draft. We have included a question in our we included a specific Australian question around whether the proposals in the ED were sufficiently aligned with the accounting standards. We didn't want to lead the witness in a way, but we're just trying to get people to think about whether there are any implications for the accounting standards by what was being proposed in the ISA. So that was what that question is about.
Well, that's helpful. Thank you. And Brad, you got to jump off. Thanks so much for joining us. We really appreciate the insights.
Look, no worries. And look, I was thrilled to be asked to do it. I hope that. Unfortunately, I have to leave the conversation. I did want to bite off there was another query, or there was another comment in the chat, and that is, does the location of the disclosures matter? Now, that's probably one that Rebecca can chat to as well, but the location of the disclosures do matter, and the nature and form of those disclosures do matter. We know that for a fact. And so whether they're buried behind or within, note 1 or note 2, investors are increasingly sophisticated in many respects. And so, management commentary versus notes to the financial statements is a thing. So anyway, maybe a conversation for another day, because unfortunately I do have to go. So
thanks
my
a lot.
apologies.
And Rebecca, I was going to throw over to you because your research had some really interesting insights on where investors are looking. It sounded like they were looking at the audit report more, which is probably good given the way it's all framed up at the moment. But if I just go to that first question, how important do you think it is to align the auditing and accounting?
Yeah, look, absolutely. In first instance, I think that they should be aligned, because of course it's not just an auditing or an auditor's decision. It is based on management's, I guess, beliefs as to the future viability of the company. So I do think that there does need to be a little bit more disclosure from an accounting point of view. In terms of my results, yeah, I did find that location does matter. So for example, a MERG is considered to be, I suppose, more severe, perhaps due to its salience. So it's in a separate section as opposed to embedded within a CAM. Again, in terms of management's disclosure, it does seem that it is discounted, I suppose, when it's paired with an auditor's disclosure, potentially due to the salience of the message conveyed in the audit report. but definitely, I guess, yeah, the positioning of the disclosure does in fact matter.
It's a really tricky one, because it's in one sense you're talking there about having a really clear signal being a good thing. If you have a merge, we know something really big is happening. At the same time, is that how does that sort of gel with the approach of having some disclosures every year, as Toby was suggesting, as we've actually recommended to that audit inquiry, where the risks are sort of exposed each year? Do you have any thoughts on that, Rebecca? Or?
Yeah, so my second experiment, which looks at recurring disclosures, sort of seems to suggest that investors become desensitized over time. So there is that risk that if you're continually alerting financial statement users to any kind of concerns year on year, that they become inured to that. I guess now that this going concern paragraph is essentially taking over a CAM when there are events or conditions, and the fact that it is still going to be headed going concern, it does raise the question that, okay, if no going concern issues are under that same heading and events and conditions are under that heading too, then what will happen after several years of investors seeing that kind of information? So yeah, there is, I guess, a question mark around that.
It's really interesting. And on that note, Toby, what are your thoughts? Do you think it's important, or how important is it for the accounting and audit pieces to be aligned, or is that, have you seen that be a problem when you were looking at financial statements, or do investors think about that?
I think I concur with a lot of the points that have been made on this. I think it's important to understand that we're talking, I guess, the scope of a standalone document, right, or a standalone annual report. And interesting, while we've been on the Zoom, there's been I've got my own ChatGPT account, and I won't say what company I was looking at, but you throw in an annual report and you can get it. You're like, tell me what the key audit matters are, tell me if there are any going concerns. And interestingly, but the other thing is you have to make it role play, right? So you tell it, you say, you are a research analyst, you're reviewing this annual report, so on, right? And one of the things it did was it kind of stayed on the fence. It didn't really come up with that much analysis, but interestingly, it played back to me the point I want to make now, which is that when an investor is reviewing going concern, they open up everything, right? So they're looking at industry news, they're looking at peer company disclosures. They're gonna make a judgment on all of this by augmenting everything else that's at their disposal. And something like ChatGPT, probably when it's fully unleashed, or AI, that is going to want to do the same thing. And so I suspect what the sort of future state of this kind of disclosure needs to think about its context, and how is it ensuring it is sufficiently relevant. And this is coming on to one of the other points in the channel, which I'd be interested in addressing around materiality. Because materiality, sorry, I just finished the first comment. So where am I going? I would concur that it does matter, because I think people still need those signposts today to understand where management view is sat and where audit view is sat. You know, and there are a couple of examples in the past where those two have differed. Sometimes that's resulted in you know, a not so great outcome for subsequent disclosure for that company, and other times it's kind of settled itself down, and you know, things have been put straight. And as of way back before I was a stock analyst, I am a chartered accountant, still a fellow of the ICAEW, and I used to have work on a number of listed audit clients, and you know, believe very strongly in the independence of the audit view as well. So it's the dividing lines between where and how the disclosure arises, I think, is important. But an investor is going to be, you know, they have a different use case, right? The audit report is potentially a validation of what management is saying, or it is additional perspective that could well bring in some of those, particularly if you're looking at, say, the financial services industry, and it's like a valuation of an exotic derivative. Well, most of the work that auditor is going to do is probably going to be informed by work that they're doing on other clients across the market. And so bringing that outside in sort of perspective, I think, has value and merit. But when it comes to accountability, the investors know that by and large resides with the management team and the board, and hence that's the role that they need to play. Just on the materiality side, so we as a company, Xero, launched we're about to publish our 23 financial year, but this time last year we published our first integrated report. And as part of that process, we undertook a materiality study that really, threw the net very wide, didn't limit itself to financial indicators. It was all types of ESG indicator as well. And it was a really interesting exercise. And I think it ultimately comes down to the meaning of materiality will vary to the stakeholder. And what's interesting about the way that some of the sustainability standard taxonomy is being formed is around the concept of materiality to enterprise value, and that ultimately is the way that investors think day to day, right? Their assessment of risks is always going to be through that lens. How is this impacting on me? And actually, and then the one other thing I just wanted to raise, which is listing company. The rules that exist within a listed environment. ASX has its own disclosure obligations that are upon companies, and sometimes they will perfectly align with the way that existing financial reporting functions, and sometimes they might align perfectly with audit disclosures. But to an extent, the continuous disclosure obligation, particularly here in Australia, doesn't limit it to those kinds of frameworks. It's sort of on the shoulders of a listed company management team and the board to make an all-encompassing assessment as to what may or may not be material to a stockholder in the event that there is something that needs to be divulged. And I think that's that it gets difficult when you're talking to outside factors. So it might be, I don't know, the La Nina may come back, right? And if you've got a portfolio of property insurance that you need to be assessing, that may or may not be something that's pretty tricky for you to manage on a go forward basis.
Yes. And did you, and Waters, do you have a thought around that same point around materiality?
Well, yeah, somebody's raised a question about materiality, and I think the question's about how important is the word materiality and versus uncertainties. I think that's an example where there's just a slight difference between the auditing and accounting standards, because the auditing standard says for the auditor to check that there's been adequate, clear disclosure that there is a material uncertainty in relation to going concern. And then I think the accounting standard talks about uncertainties. I suppose I would have thought that material generally resonates with people, and they understand what that it means, that it's big. And I'm assuming that's why the auditing standard used the term material uncertainty.
Yeah, that's a tricky one. I think actually, as we've been having this discussion, I feel like it's slightly unfair. One of our observers, Anne Tarker, who many of you will know from her work in the academic world, but also a member of the International Accounting Standards Board. So as we're talking about all this, it's sort of it strikes me that that Anne may have some views around that particular point about materiality, but also, Anne, if you had any other thoughts on any of what we've been discussing, would be fascinating. It's fascinating to hear that.
Thanks, Amir, and hello, everyone. Very, very interesting session. And thanks for inviting me to comment at this stage, Amir. I'll jump in on the material following on from Anne and Toby. And people are picking up on the subtle difference in the language there. But let's just step back. Accounting disclosures are only the disclosures that are material. So when accounting standards talk about an uncertainty, it's a given that it's a material uncertainty. There is an overarching requirement that disclosures are material, and auditors are working with that all the time. Companies are working with that all the time. Toby's talked about the decisions that management and directors need to make around disclosures, and we talk about materiality as being an entity-specific aspect of relevance. So we're looking only for those material disclosures. So in accounting standards, you don't see the word material everywhere because it's an overarching concept. So auditing and accounting are coming from the same place on this, and it's all about the material disclosures. But the work of the ED that we've heard about today for the AUASB raises some really interesting things, and there's comments in the chat about, well, what are these disclosures that are being cross-referenced in the ED? And of course, they are the accounting disclosures. We started the session by saying that Anne said the response from the IASB is that it's a principle-based disclosure around going concern. And the IASB does that, not to be difficult, but to accommodate the diverse reality of different companies. So companies need to be making those decisions themselves, and auditors, of course, help them with that. The other thing here that I think we haven't touched on today in this panel is the sensitivity around going concern disclosure. And so we're very aware of the ability of companies to provide information that is relevant for the investors, but equally they are concerned about causing adverse reactions on something. So that's where the whole question of things being material come in. But great discussion, and I really appreciate the discussion around what's coming down the pipeline in terms of so many things in the future, how to bring more of that into the current reporting landscape, wherever we decide to make it appear. But to Toby's point, when he mentions the ASX, the auditing standards, the accounting standards, the reporting is happening in an environment where there are a number of influences, and what we're all seeking is better information for investors, and that can come from each of those different bodies having a role and creating the disclosures in response. So I think that's an important thing to remember, and we at the IASB will of course be monitoring the IASB project very closely. So Amir, thank you for the chance to comment.
I appreciate it, Anne. You didn't have the warning to be part of the panel today, but really appreciate your weighing in on that. And certainly I know that you were involved in the work on management commentary, for example, at the IASB, which is very relevant to disclosing those risks. And in fact, then all the work being done on sustainability, as Toby mentioned, is very relevant to that piece as well. But that kind of gets, I guess, into a question that I'm often struck by when thinking about when this becomes really prominent in the public sphere. As I said at the beginning, that's when companies fall over for, whether that's right or not, whether, but it seems like there are possibly two different questions here. One is the going concern assumption an appropriate basis to do the accounting? Another question is, what is the prospect of this business actually failing, or what are the risks? And those are two different questions. But when I've sat in front of the Parliament in Canberra, they certainly see it as the same question. They certainly see the auditor signing off on going concern as, well, hopefully not a guarantee, but certainly that is the best. And at the end of the day, whatever we say to explain it, that's probably the best they've got right now in terms of information going to that question of business failure. So when they sign off and then 4 weeks later a company collapses, may be very reasonable when you look at that in the context of the accounting and auditing rules and standards and the entity's circumstances. but it raises a lot of questions from a reputation perspective for those involved, plus the wider profession. But Anne, what are your thoughts on that as you've looked at what the AUASB heard? As I know some of that work has come on the back of a tour, a bit of a tour of seeing what different stakeholders are concerned about in different jurisdictions.
Yeah, no, thanks, Amir. I agree. I think people have a belief that if the auditor's signing off that the entity will be around for 12 months. That's not necessarily what they're signing off on. They're saying that if the going concern basis of accounting is appropriate, that's based on information that they have at that time, that there's nothing to suggest that the entity won't be around in 12 months' time. But things can change very, very, very quickly. So they can only base it on the information that they have at that time. So I sometimes wonder whether there should be some disclosure around assumptions or key business model factors, etc., that the entity considers are really important to the long-term viability of the entity. And I don't want to use the words because that's what the UK is using, but maybe it's more around what were some of the significant assumptions that are really that underlie the fact that that based on the information at the moment, this entity will be here in 12 months. But definitely the auditor's not signing off that the entity will definitely be here in 12 months because things can change very quickly.
Yeah, and I think it's that viability idea that was intended to tackle that in the UK, because they probably went, the Parliament over there in the various inquiries after a number of different corporate collapses probably went deeper on going concern than I've seen policymakers go in just about any market elsewhere. And they did seem to land on the fact that it's not sufficient. Toby, what do you think? Do you think investors really understand, not to mention any names or anything, but in large part, do they understand what the going concern basis is about, or are they looking at it as a kind of a sign off on the viability?
I think it, I don't know if most investors would like to think that they wouldn't want to be anywhere near the company by the time that a going concern risk becomes so prevalent, right? But having said that, there will be types of companies, there might be technical circumstances where going concern is something that, particular specialist investors, maybe sort of low grade credit investors, or you might have certain types of hedge fund that have got the risk appetite to really seek out companies that may have obvious or more readily identifiable going concern issues, or that maybe they've had they've had material uncertainty disclosures that have persisted for some time. The vast majority of certainly large cap listed companies are probably going to have quality scores that would mean that it'd be difficult to really identify a large number of disclosures of this nature. But certain sectors and exploratory mining companies, biotech, small cap listed technology space more generally, where success or failure is really very diverse as an outcome. I guess applying a bit of theory here rather than practice. I mean, if they're running a portfolio where they're backing a lot of companies, then their appetite to sort of I guess trade, for want of a better term of phrase, trade on the information, take positions, take a view, is probably going to be a lot more of a sort of day-to-day, more vanilla practice for them. But I think most institutional investors would be using going concern for them. It's sort of like, well, it's the end game that I'm trying to avoid, or I don't really want to go near it. The merit is really just about ensuring that I've got the right sort of sense of direction of travel when it comes to key risks.
And you mentioned the continuous disclosure regime in Australia.
Yeah.
And having worked at Bank of America, and it sounds like a really great experience internationally, that's a reasonably unique piece, set of requirements, as I understand it, although I'm no expert on that. But does that make things in this respect better in Australia? Does it solve it to some extent, the issue, or what do you reckon?
Yeah, I'll come down this. So my Australian citizenship is lodged. So full disclosure, this is a British person making this point. But I will be in Australia soon. It's just different. It's hard to say whether it's better or not. It does lead to different outcomes. It means companies can't surprise because literally you're not allowed to, and the way that continuous disclosure operates. If you're, I guess the only outcome where you can surprise is if you're surprised yourself, which has maybe got its own issues. But in other parts of the world where there maybe isn't, there are other derivatives of continuous disclosure. New Zealand has something similar, I think, but it isn't. Yeah, I think Australian settings are they keep things neat and tidy, right? And that's why we have confession season, as I like to call it, which is round about now for a lot of companies that sort of past the point of no return with regard to a June year end, and there's not enough time left in the financial year to kind of avoid things. So that often, I think, tends to be the reason that things tend to crop up. So it definitely keeps the numbers fresher, but it can also create a lot of noise, right? It creates additional reporting, and it can sometimes undermine confidence for technical reasons, not necessarily for fundamental reasons that may determine value over the a more long-term time horizon.
Yeah, thank you. And I guess one part of that is it hasn't necessarily stopped us from having our own set of surprising corporate collapses over the years as well. But Rebecca, I think we've come to the time when we probably need to sum up. So Rebecca, I was quite interested in your thoughts on that piece, the desensitization versus, not wanting to go anywhere near something once it gets to the material. I mean, you'd want people to be pretty sensitive to that. But also, do you have any sort of final thoughts just to sum up before we close the session?
Yeah, I think, I suppose the risk is that if you're continually alerting any financial statement user to any particular risk, then it does kind of lose its salience over time and any weight that might initially be attached to it. And I guess that's what I kind of allude to in my findings. But of course, because, it is under that different heading, going concern, of course, there would need to be, new research which actually looks at whether or not that has any impact on users. I can only allude to what might happen based on my findings, but of course, it doesn't really touch on that specifically.
Thank you, Rebecca, and really appreciate your insights this afternoon. Anne, any final observations or thoughts?
Well, I suppose there is a question in there in the comments, which we'll probably cover, but just in summary, going, well, if the auditors checking that the disclosures are appropriate anyway, and the auditors following the auditing standards, don't you get to the right place anyway? And I'd say yes, you do, except for I would have a concern that it's management and the directors who know the business really well and are the best placed ones to identify risks and put strategies in place to address those risks. So they should be driving disclosures, because auditors may miss something. And my other closing comment is we have an exposure draft out. Please have a look at it, everyone, and we're interested in feedback.
Excellent. Thank you so much, Anne. And I guess the other side of that is you're making things a lot harder for auditors with that lopsidedness. Although I've given away my own, I'm supposed to remain neutral here, but given away my own bias there. Toby, I'll give you the last say. Any final observations or thoughts after the discussion?
So I'll say two things. One is that I think it's really great that the user is, at the end of the day, there's a lot happening on multiple fronts, but I think really the user needs is what's driving a lot of it. So I think the sort of sense of purpose around a lot of the hard work and time and effort that goes into development of new standards and revising existing standards is well it's got its sort of focus set in the right place. Sort of putting a bit of a commercial bent on it. I think actually both the auditing the auditing industry and the advisory industry, to an extent, when it comes to shaping the output of preparers, it's a really interesting sort of phase that we're entering into. There's, I think, a real commercial opportunity almost to sort of work with what's coming with regard to auditing and accounting standards and craft really user-friendly disclosure that again really assists what users are doing. So I as difficult as it may be for the auditors or the accountants, I think that there's a really interesting opportunity there for them to show what they can do and to compete with their industry peers.
Thanks, Toby. I think that's a good place to end it with a good call to action. And we certainly do have a lot to do. And thank you to all our panelists, Rebecca and Toby. Appreciate all your insights. Of course, as well as Anne Tucker and also Brad Potter, who had to jump off. So without further ado, it's back over to you, Eric. And thanks for everything you've been doing, and Charles, to bring all of these great sessions together.
And thank you, Amir, for chairing and leading the discussion. It's been really interesting webinar. We have heard so many different views from different perspectives. And also I'd like to thank you for everyone's active participation. The next dialogue series session will be held in October, and we'll delve into the topic of the understandability of accounting standards. And I also want to thank you, the CPA Australia and CANZ for partnering this joint session. That's everything from us. We look forward to your continued engagement and participation. Have a good evening, everyone. See you next time.
Thank you.
Thank you.
Thanks, everyone.